Let's get more from James Bullard, Dean of the Mitchell Daniels Junior School of Business at Purdue University and former president of the St. Louis Fed. Thanks very much for joining us.
Happy to be here.
I mean, the U.S. economy, a bit like the Energizer Bunny, it just keeps going. No sign of a recession, it seems.
Yeah, I think that the recession forecasts were overweighted in the spring after the failure of SVB, but that bank was a quirky bank and the other banks are much more conservatively managed. So it led to a forecast of recession, but instead the U.S. economy grew very rapidly in the third quarter, and now tracking estimates for the fourth quarter are for above trend growth as well. So the idea of an imminent recession is being gradually taken off the table here, and that's really fueling a lot of the sentiment in global financial markets.
And we have seen this pretty serious rally, of course, over the past few weeks in stock markets. Bonds coming down. Why have bond yields come down so much? People are just not worried about inflation?
Yeah, I think the disinflationary trend has been very encouraging for the Federal Reserve and for markets. I think a lot of people are citing the 6-month inflation rate. If you annualize that, you'll get a number pretty close to 2%. So, I mean, I never liked really to look at the 6-month number as opposed to the 12-month number, because I think the 12-month filters out some of the seasonal adjustment quirks a little better. But nevertheless, very encouraging that inflation has come down as quickly as it has. And the Fed can't wait until they get all the way to 2% to start cutting rates. They're going to have to think ahead a little bit. And exactly how they'll do that in 2024 is what everyone's debating.
When do you think the first rate cut it will be?
Yeah, markets seem to be pricing in March. I would say that that could happen, but the Fed would need some good data continued good data on inflation between now and then. If inflation hangs up a little bit or goes up, then I think it would get pushed back, and the committee would want to be really sure that inflation really is coming down, well and truly done, I think Jay Powell said, before they start cutting the policy rate, because the 70s example is one where the Fed eased too early, and then you got back into a long tangle that took years to unwind. So they don't want to get into that. We've
all seen those zombie movies where they keep coming back. Yeah, that's right.
Exactly.
I suppose highly indebted governments like the United States and, of course, Canada are happy to see long-term rates coming down because it reduces that huge debt servicing burden.
Yeah, so the chart I have in my head about this is going to be a little approximate here, but at one time, I guess before the financial crisis in the early 2000s, the debt service was about 3% of total fiscal expenditure in the U.S. Then interest rates went way down after, between 2009 and 2019. So the debt service was only 1% of total fiscal expenditures, federal expenditures. And now it's gone back up to about 2%. So we're not actually at that same level that we were at in the early 2000s. So we have a little headroom, plus rates are coming down some recently. And so maybe we're okay in the near term. Also, the debt to GDP ratio in the U.S. actually been falling partly because of inflation. The nominal GDP went up rather quickly.
I know that things can get technical here, econometric, but you have in the past, as far as I know, said that we should pay attention to the so-called headline rate of CPI. And you're a little skeptical about these so-called core rates. Could you enlarge on that?
I mean, the Fed's official target is based on the headline PC inflation rate. That's our best measure, broadest measure of what everybody actually has to pay. And all the, you start stripping out gasoline and food and other energy. I think that people don't relate to that because those are things they have to pay on a monthly basis or a weekly basis even. So I think these core measures are can be useful, but you have to keep them in perspective. It's really the headline number that matters to households.
Just leave us with a final thought. I know I'm jumping around, but what about productivity per worker? It's a big problem in Canada, and I think it has been a concern in the United States as well. Is there any sign of that improving, that trend?
I think we're still on this low productivity growth trend, unfortunately, but some of the very recent numbers in the US have looked better. It sure does seem like there's a lot of great technology around that can be used to improve productivity. And I'm hopeful that, we'll bounce back into a high productivity growth scenario the way we did in the late 1990s. That was one of the best periods in U.S. post-war macroeconomic history.